Good day, future accountants. This is Ian L. Fermento, and I will be discussing about the role of International Monetary Fund. The International Monetary Fund was originally set up under the Bretton Woods system to help countries deal with balance of payments problems and stay with the fixed exchange rates by lending to deficit countries. When the Bretton Woods system of fixed exchange rates collapsed in 1971, the IMF took a new rules. The IMF continues to function as a data collector and provide technical assistance to its member countries. Although the IMF no longer attempts to encourage fixed exchange rates, its role as international lender has become more important recently. In 2010, the IMF made large loans to Greece, Ireland, and Portugal to help them avoid a default on their government debt. This role, which the IMF acts like an international lender of last resort to cope with financial instability, is indeed highly controversial. So, should the IMF be an international lender of last resort? In emerging market countries, where the credibility of the central bank as an inflation fighter may be in doubt and debt contracts are typically short-term and denominated in foreign currencies, a lender of last resort operation becomes a double-edged sword, as likely to exacerbate the financial crisis as to elevate it. The resulting increase in moral hazard and adverse selection problems in financial markets, along the lines discussed in the previous chapter, would only worsen the financial crisis. Central banks in emerging market countries, therefore, have only a very limited ability to successfully engage in a lender of last resort operation. However, liquidity provided by an international lender of last resort does not have these undesirable consequences, and in helping to stabilize the value of the domestic currency, it strengthens domestic balance sheets. Moreover, an international lender of last resort may be able to prevent contagion, the situation in which a successful speculative attack on one emerging market currency leads to attacks on other emerging market currencies, spreading financial and economic disruption as it goes. Because the lender of last resort of emerging market countries is indeed or needed at times, and because it cannot be provided domestically, a strong rationale exists for an international institution to fill this role. However, support from an international lender of last resort brings risk of its own, especially the risk that the perception it is standing ready to bail out irresponsible financial institutions may lead to excessive risk-taking of the sort that makes financial crisis more likely. In the Mexican, East Asian, and Irish crisis, governments in the crisis countries used IMF support to protect depositors and other creditors of banking institutions from losses. This safety net creates a well-known moral hazard problems because the depositors and other creditors have less incentive to monitor their banking institutions and withdraw their deposits of the institutions are taking on too much risk. The result is that these institutions are encouraged to take an excessive risk. An international lender of last resort must find ways to limit this moral hazard problem, or it can actually make the situation worse. The international lender of last resort can make it clear that it will extend liquidity only to governments that put the proper measures in place to prevent excessive risk-taking. One problem that arises from international organizations like the IMF engaged in lender of last resort operations is that they know how if they don't come to the rescue, the country will suffer extreme hardship and possible political instability. Politicians in the crisis country may exploit these concerns and engage in a game of chicken with the international lender of last resort. Let's continue. How should the IMF operate? The IMF would produce better outcomes if it made clear that it will not play this game. just as giving in ill-behaved children may be the easy way out in the short run, but supports a pattern of poor behavior in the long run. Some critics worry that the IMF may not be tough enough when confirmed or confronted by short-run humanitarian concerns. For example, these critics have been particularly critical of the IMF's lending to the Russian government, which resisted adopting appropriate reforms to stabilize its financial system. The IMF has also been criticized for imposing on the East Asian countries so-called austerity programs that focused on tight macroeconomic policies rather than on microeconomic policies to fix the crisis-causing problems in the financial sector. An important historical feature of successful lender of last resort operations is that the faster the lending is done, the lower the amount that actually has been or has to be lent. The ability of the Fed to engage in a lender of last resort operation within a day of a substantial shock to the financial system stands in sharp contrast to the amount of time it has taken the IMF to supply liquidity during the recent crisis. Because the IMF lending facilities were originally designed to provide funds after a country was experiencing a balance of payments crisis, and because the conditions for the loan and to be negotiated, it takes several months before the IMF can make funds available. By this time, the crisis can get much worse, and much larger sums of funds are needed to cope with the crisis, often stretching the resources of the IMF. One reason central banks can lend so much more quickly than the IMF is that they have set up procedures in advance to provide loans with the terms and conditions for this lending agreed upon beforehand. The need for the quick provision of liquidity to keep the loan amount manageable, provided quickly, or argues for similar credit facilities at the international lender of last resort so that funds can be provided quickly, as long as the borrower meets conditions such as properly supervising its banks or keeping budget deficits low. Countries built up substantial cushions of international reserves to deal with balance of payments problems on their own. IMF lending therefore shrunk to very low levels, even creating a shortfall of revenue for its operation because it was no longer earning income by taking loans. The IMF was at risk of becoming irrelevant until the global financial crisis. With the global financial crisis, the IMF's role as international lender of last resort returned. The debate on whether the world would be better off with the IMF operating as international lender of last resort is currently a hot one. Much attention is being focused on making the IMF more effective in performing this role, and redesign the IMF is at the center of the proposals for a new international financial architecture to help reduce international financial instability. So that's all for today's video.